Hey guys, this is Downtown Josh Brown. Welcome back from Labor Day. Another all-new edition of What Are Your Thoughts? I'm here with Michael Batnick as usual. We have a ton of stuff that we're going to ask each other about, and neither one of us has any idea what we want to discuss. So this should be fun. We love playing this game. Play along with us in the comments. Let's go. All right, Mike, let's start with, I think, the thing that we can't ignore, the Nasdaq Whale story that broke over the weekend. And for the viewers that aren't aware of what I'm talking about, let me just give a very quick synopsis. There's a rumor that's been reported by the Financial Times and now repeated by everyone that Softbank, as in Softbank WeWork, Softbank Wirecard, and every other insane YOLO investment, bought $4 billion worth of large cap tech call options. So betting on tech stocks continuing to go higher. And that has had the effect of juicing the stocks themselves. So SoftBank basically is forcing the seller of that option to buy those stocks in order to hedge their position. And people are saying that that's what single-handedly drove the NASDAQ to new highs over the last couple of weeks. I call BS. Mike, I wanted to hear what you had to say on this.
What a softball. I love that BS call because I got something for you.
Okay, what do you got?
So Ben Eifert, who is this super smart, nerdy option volatility guy, and he wears that badge with pride, that's not disparaging, did a whole tweet storm about what actually is going on. And he looked at, on one hand, you have the Robinhood traders, and on the other hand, you have the Softbank, the whale. And he looked at what's actually happening. So bear with me. I'm going to read 4 tweets to give an idea of what's actually happening.
Okay.
He said, a day trader who bought a 1-week 32.50 call with Amazon at 31.48 would have paid about $15 for the premium.
Okay.
The delta was 21%, meaning that that's deliverable into 100 shares. 21% of that is, so it's the equivalent of 21 shares or $66,000 worth of Amazon exposure. Again, for $1,500 worth of premium. The market maker who she buys the calls from is going to hedge that exposure immediately. So the next day, Amazon moves up 1%. The call price increases to $15.50. Its delta moved up 26%. So they have to buy another 5 shares. 26 shares total to $82,000 of stock. Again, $82,000 worth of stock buying for $1,500 worth of premium. And this keeps going on and on and on until it got to a $230,000 position. And this is happening on the weekly. So Robinhood traders, and not just Robinhood traders, but lots under 50, so small traders bought, I think, $40 billion worth of premium. $40 billion. So the notional amount is enormous.
Yeah.
So he contrasts that on the one hand with what SoftBank actually did. And he said SoftBank, they're buying 3 to 6 month maturities. So it's completely different. He said, based on color, he said the large institutional call spreads have been discussed. These total a few $1 billion in mega cap tech names. Based on color from Flowdesk, these trades were mostly executed versus stock, which means that the client bought the call spreads and sold stock, executing a delta neutral trade. So these transactions themselves did not represent meaningful buying pressure on the stock. Okay, so just to wrap up, you've got the short-term retail traders that are buying weekly options that actually does drive buying.
And SoftBank is not in that market.
SoftBank is either, they're doing spreads, so they're buying one, they're selling another. There's no net buying pressure on the stock. So even though the dollar amounts are enormous, $4 billion worth of premium, it's 3 months out, it's 6 months out, and they're selling. So I think the real story was more of the retail traders that are just piling into these names.
All right, so I'm glad you brought that up. First of all, SoftBank executing call spreads, it's a way to bet on the upside of these giant tech stocks, but to not take the full potential downside. And I think the call spread buying is what gives you a situation where the NASDAQ makes new highs and the VIX rises alongside with it.
Exactly.
So that's definitely a strange thing going on. I also believe that the SoftBank whale is out there doing these trades. I'm not saying the reporters are wrong about this or the.
Well, they just missed the nuance.
I think that it's a drop in the bucket compared to the speculative retail activity that's really driving this. It's not. So people are saying Softbank is the new LTCM, and the long-term capital management. The implication is just like LTCM single-handedly blew up the stock market in 1998, the global stock market in 1998, and had to be bailed out. People are like equating what SoftBank's doing to that, and I guess my take is no, I don't think so.
No, you're right. The answer is no. What also could be happening though is that people are front running them, so there can certainly be ripple effects, no doubt, but they're not like the lone force. So there were some other charts that Ben showed and some other people showed. If you look at like contracts above 50 usually dwarf the smaller ones. That has reversed. Usually buying on index options are bigger than individual names. That has completely flipped. If you look at the rolling 1 month average daily single stock call volumes on Facebook, Amazon, Apple, Netflix, Google, Microsoft, and Tesla versus the rest of the market, it's just exploded. So what's going on is absolutely nuts, even though it might not just be exactly as clean as the headlines we're reporting.
All right. So there's a chief strategist at RBC named Amy Wu Silverman. I've not heard of her, but she agrees with us. She's saying call option volume started spiking in March, April, and May, and that was mostly retail. She said what really happened was the contract sizes got smaller and smaller, which is not institutions. But then she's saying big institutional trades in technology stocks started to arrive in August. And she started talking about these call spread trades being the hallmark of an institutional bet. And those were like Microsoft, Facebook, Adobe, Salesforce, Alphabet. But she's saying by the time those institutional call spread options trades started to show up, the Nasdaq 100 had already rallied 60% off the March lows. So actually, the institutions are following the retail investor into this kind of activity, which I find to be absolutely fascinating, don't you?
Yes, and this chart showing that single stock calls option volume is above indexes and ETFs. Think about that. People are buying more Facebook, Apple, Amazon calls than they are just SPY or Qs.
Right.
That's nuts.
Right.
All right, sticking with this theme. So now Apple, just for a brief moment, was bigger than the entire Russell 2000, and it's bigger than the FTSE 100. So the biggest names in the FTSE 100 are AstraZeneca, GlaxoSmithKline, HSBC, British American Tobacco, Rio Tinto, BP, Unilever, Royal Dutch Shell. I mean, these are big companies. Apple's bigger than all of them.
You're leaving out some of the most important British blue chip companies.
Go ahead.
I don't know why. Amalgamated Fish and Chips. I don't even know if most U.S. investors could identify more than 3 English publicly traded companies. Like maybe they could think of a bank, but it's actually
HSBC.
Yeah, so they could come up with that, or Royal Bank of Scotland. I think that trades on the like if you put a gun to someone's head and said name 3 publicly traded companies based in England, I honestly think that they would have trouble. I maybe could do 10 or 15 offhand. So I think that is a bigger statement about just like how minor league the British stock market is versus what it used to be than it is about the size of Apple. Apple dwarfing the entire Russell 2000, I think is very interesting. I think the issue there is just that the way that index is constructed, those companies are meant to be tiny. They're meant to be small. They have a dollar, right? Don't they have a dollar amount limit?
Yeah, no. Yeah, but it floats. So as things get bigger and bigger and bigger, it's not like as tiny as it used to be.
Does it float, or is it just a set number under a certain amount of billions? I don't know.
I think it's got to float. It's got to be inflation adjusted. So let's just say, like in the 90s, that number was a cap of $1 billion.
Is it the smallest X% of stocks, or is it stocks with market caps under 10 billion?
Yes. It's the Russell 1000.
Okay.
And then the 2000. So the 2 and the 1 are the Russell 3000. So it's the next biggest 2000 stocks. So by definition, it's going to get bigger and bigger and bigger over time.
Well, apparently it's not right now, though.
Not relative to Apple, sure.
Right. Okay. All right. I want to get into this idea about there being 2 recessions, because I think it goes a long way toward confirming what you were doing on the blog last week about how we're experiencing both 1999 and 1929 at the same time. So now here's the numbers through August. You have 13.6 million people unemployed. You have another 6 million on furloughs waiting to be brought back. So that's 20 million people collecting unemployment and not currently working, right?
The longer the furloughs go, by the way, the harder it is for those people to be brought back.
Yeah,
they're not coming back.
The history of furloughs is not great, like in terms of like what percentage come back. Okay, now while that's happening, this is from Politico. They did this story about there being two economies, and I think it's dead on. Americans saved a stunning $3.2 trillion in July. That's the same month that 1 in 7 households told the U.S. Census Bureau that they sometimes or often don't have enough food. So more than a quarter of adults surveyed have reported paying down debt faster than usual. And the same number, more than a quarter of U.S. adults said they're unable to make rent or mortgage payments or pay a bill. So now you take the unemployment rate for high-wage workers. Let's just substitute college-educated workers. The unemployment rate is now just 1% from where it was very quickly into the pandemic. And they're saying college-educated unemployment is back to 5.2%. It was 1.9% in February, so it's worse than then. But at its worst, it hit 8%. How do we ever get out of this? Like,
I don't know.
What is the answer? Like, what is even the answer?
It's bad. I was reading this morning, looking under the hood of the August report. In August, there were 6.5 million people who were out of work for 15 to 26 weeks. That's up from 830,000 a year earlier. In July, more than 50% of those on temporary layoff were unemployed for 15 weeks or longer. And this is the sort of stuff that like really rips at the fabric of society. When you have people who are unemployed for long periods of time that cannot re-enter the workforce, this is really, really bad.
And it's not just them; it's what happens to their families, what happens to their children, because their children now are growing up in a reality that's very different than the reality that other people's children are growing up in. And what does this do to like entire communities that are based on this kind of work? I honestly don't know what's like. The Mortgage Bankers Association said this morning that in the second quarter this year, so we're talking about April through June, right? There was $1.1 trillion worth of borrowing and lending activity for homes. So that is the segment of the economy that has not lost their job, right? For the most part. Maybe there are some distressed refinancings, but I would assume those are rare. So that's happening. Then you look at automobile sales, and I know that you just leased yourself a truck. U.S. motor vehicle sales accelerated from 8.7 million units in April to 15.2 million units in August. That's got to be the biggest turnaround in history for auto sales in that compressed of a period of time. And they're actually at all-time highs. Retail sales of motor vehicles and parts dealers, sales rose to a record high in June, stayed there in July. So how do we have these two things going on at the same time and say that there's an economy? There really isn't. There's two different economies. One for the people that haven't been affected by the pandemic, and another economy, an entirely different economy for the people that have. And I think
there's three. There's people that have been left behind. There's people whose lives are uninterrupted, and there's people who have never been doing better.
Okay, that's a good point. Then there are people that like this is the greatest thing. Let's say you sell boats, or let's say you sell pickup trucks, RVs,
or bicycles,
camping equipment.
Yeah,
right. These people are like, I wish we had this every year minus the health issue. So I guess I see it that way. I get concerned that the longer this divide exists, the worse things get for these families that are on the wrong side of it, and then the more volatility that translates into politically.
100%.
But I don't have any answers or any solutions other than the state has to continue to take care of these people. There's no other way, at least right now. So hopefully that continues. All right, what do you got?
All right, so a lot of colleges let kids come back in, and after 1 week, 2 weeks, there's outbreaks all over the place, not surprisingly. I think that these universities should keep the kids quarantined for 2 weeks. Doesn't it seem insane that this was obviously going to happen, and now they're just sending the kids back home to spread it to the rest of the country?
That's the stupidest thing ever. Keep the kids in the dorms. And if you're a senior citizen, Do not be anywhere near a college town. Like, get the out of Ann Arbor. There's no reason for you to be there right now. You got to find somewhere else to be. Because I would say college campuses and the surrounding environment are going to be among the most dangerous potential outbreak places. And I'm not a scientist. I watch kids. I watch how kids are dealing with this. It's not that they're irresponsible or they don't give a shit or blah, blah, blah. You're in your late teens, early 20s. You're at your most devil may care, right? Like, let's just face facts. And these kids are not going to stay away from each other. They're not going to not party. They're not going to not hook up. So we all understand that these are things that it's very hard for anyone to regulate against. So maybe we just have to steer clear. But I totally agree with you. You're sending kids home from a place where there's an outbreak to infect their parents. Maybe you mean well. It's gonna make everything worse. If college kids are getting this thing, it's unlikely that they're gonna die in the same numbers as boomers will. So I think that's
this is so obvious. If they're going to take the tuition, then take the responsibility of quarantining them for 2 weeks before sending them back to wherever they go. All right, what do you got?
By the way, all my friends with college-age kids that sent their kids this year, most of them for the first time, like they sent their kids as freshmen, they were all saying, like, look, I know the school is having us send the kids just so they can collect the full tuition.
Yeah, of course.
But you know what? Colleges have employees too.
Okay.
So if you keep those campuses shut, it exacerbates unemployment. So I think we just have to rely on there being outbreaks that then get contained, because we're getting better at containing than we were in March and April. You just have to count on people doing what's smart and what's best. I don't think we can go back to individual bubbles ever again. So look, that's what I hope happens. Last weekend on the podcast, I did this thing about the big five giant tech companies: Facebook, Alphabet, Amazon, Apple, and whatever. And basically, like Microsoft, what are the specific risks to each of those companies, and which one is most likely to still be in the top 10 stock market caps 10 years from now? Because it's very unlikely that companies can stay there, or at least all of them will stay there. And like, who's the most invincible and who's the most vulnerable? I wanted to get your take. Who do you think has the best shot at still being a top 10 market cap stock in 10 years?
I think in 10 years, all five could remain. I don't think 10 years is very far away. I think
Really?
20 years is a different conversation. Like in 10 years, I think probably Amazon and Apple.
Those are my picks as being the most invincible.
But I think that like, out of all of them, I know Apple is definitely not just a hardware play anymore by any stretch of the imagination, but who knows what the next wave of technology in terms of how we communicate with each other. Is that going to be a chip in our brain? Like, is it going to be the iPhone forever and ever? That's not 10 or 20 years away.
The big risk to Apple is probably not somebody's going to make a better phone. The big risk is probably somebody breaks down that barrier in the App Store and takes away the 30% take rate that they're getting for every single app under the sun. To me, that would be my guess. But I guess I would say that Facebook is the most vulnerable, like the one that I think has the least shot at staying there. And that's not to say I don't think it will. What do you think is the most vulnerable?
I think Facebook.
Right. And then second, maybe Google, just because people might search differently than they do now. I know it's a weak take. All right, what do you got?
All right, so Tesla did not make it in.
Snubbed.
Now they're down almost 30% from the high. It's Tuesday morning. They're down 18% today. Shares were a high of 500. Now they're at 343.
Sick. Yo, they put Etsy in the S&P. They put Etsy in the S&P 500 and snubbed Tesla. It's bananas.
So Santoli wrote a good piece this morning that in November 99, Yahoo came into the S&P the same month that Dow let in Intel and Microsoft. And that was pretty much the end of the party. So
what? So it's good that they weren't added?
No, I mean,
that would have put a top in?
No, but I totally understand the S&P not wanting to look like clowns. Like, we're going to put this stock in after it quadrupled in the last 6 months. What are you, nuts?
Well, also, it's probably the biggest case of investors deliberately front-running an inclusion. Like I know that's happened
in terms
before.
in terms of dollars amount, not even close. There's nothing even close.
Dollars, but also just like media hype. Like when was the last time before Tesla that you can remember people talking about buying a stock because it was about to get included in an index? I can't remember.
Maybe Facebook.
Maybe, but I don't even remember it. Yeah. So how notable could it have been? This time it was like the coming attraction of a movie. It was like a trailer that you see everywhere. It was like a James Bond movie where everyone's like buzzing about it in advance. Like they even had dates in mind. We talked about it here. So now they can't ignore it forever. But maybe the fact that it's dropped, if it stays down, they can add it at a lower weighting quietly.
They're waiting for it to drop to the 200-week moving average.
They're waiting for earnings. I think the committee probably just looked at it and said, we can't do this because the stock is like the Wild West. Yeah. And I also think that they pay attention. Maybe I'm wrong. I think they pay attention to earnings quality. And the way Tesla got to 4 consecutive profitable quarters was really selling credits, the regulatory credits for cars they hadn't sold yet. And it's not that.
And I think also taking down CapEx like temporarily, right? Or something like that.
That's not typically the type of earnings or the quality of earnings that I think Standard & Poor's would look at and say, yeah, we have to have this be a 4% or 2% weighting in our index. So I have to believe that quality of earnings played a role. I don't know. Did they discuss it? Did they discuss it at all? Or they just snubbed it and didn't say anything?
I haven't seen anything about it yet.
I haven't either. I wonder if they don't owe anyone an explanation. It's just an index. It's not like they're not letting the company trade. The company can still trade as long as it wants. This is just inclusion in an index. I don't think they have to explain it. All right, I thought that was weird. What do you guys think, though? We love your comments. We love your feedback. We want your takes on all of the topics above that we've discussed today. And go ahead and leave us a like. We need the likes. We love the likes. We like them too. So let us know what your thoughts are. Give us a like. Make sure you subscribe to the channel. We will be back next Tuesday, and we can't wait.